Right. Got audio, I hope, today. It's not terrible and choppy. Okay, so let's take a look at what's going on in the market right now. We had some important events and I wanted to go over what was going on. All right, so yesterday into the close, the condition was really important to keep in mind. The bulls had dominated. They wanted to liquidate those positions. And we tracked those positions as here, here, and here, looking to get up and liquidate through this area here, and we were able to take out just every position you could ask for. You can see tension popped up as a result of liquidating or forcing those positions to unwind market wide, and the market opened. The very first concern that you should always have after one side of the market dominates is teeth. And we cover this all the time. Teeth is where that you have essentially a swing position and you're not really all that concerned with moves back down. And I think in general, this is teeth. If you're bullish and you were buying in yesterday here and here, and you're holding a position, this hasn't even close to come to threatening you. And that's important because it talks about the teeth. And I call them teeth because, well, they look like shark teeth. And that's it. And they feel like you just got bit, especially if you're trying to participate with them. And in longer term moves where that they're, a swing or something, you could find yourself getting bit by teeth, and they tend to be very sharp. And then markets could continue on, and it's that you just got pushed out. And it makes sense because your initial position, or the market's initial position, is profitable, and these little moves back don't pressure the overall narrative that's going on. So that's the first thing to keep in mind right off the open, always after one side of the market shows dominance. So let's take a look at where these people are. I'm going to go through this quick because we have some stuff going on here. We have bulls came in, and this, you see how this pushed under right about here, and it took quite a while before it found some volume. So this was, you get the signal and it took a while to find the volume, and that's never a good sign. What that means is that you're watching the market have some product, and the distance between, or the amount of time between when the product is being sold and the people see it and try to consume that product, it should be immediate. It's like they couldn't find anybody to purchase the product. Nobody wanted it. We got another sample here for the bulls, and the volume showed up pretty immediately right there. So we get two bullish samples, and you can see that they impacted the market but failed to hit. So prices were not rising out of this one. You can see it just didn't take. The bears came in and they were able to get sampled right here and again here. So we had sort of a back and forth between these two. Excuse me. The bulls were here and here. The bears got sampled right. They didn't get the volume till there, and I'm just looking at right here because it pushed under. This one wasn't quite under and then pushed back up, and we're getting, anyway, this was the volume that really mattered. And what happened here was bears came in and they hit. Now they ran into one issue that is important to notice. They did not impact tension as it moved. So these bears were hitting with one focus: to push bulls out. That was it, because it dove and dove and dove until right into this last section here, tension curls, and that was these bullish positions getting pushed out of the market right there, and we have bulls liquidated. They got pushed out by the bears. Now, the bears had absolutely no follow through. As soon as those bulls got liquidated, the market moved back up and tension continued to rise. What happened after that? And this is where it gets interesting, and you need to pay attention to these little details. We saw trapped orders into decay pushing under. This was not a bullish sample. Bulls did not get sampled here. There was nobody there for the bulls. And right here, it dipped down. These trapped orders stopped as soon as the sample happened. There were no bulls, no bulls. This did not sample the bulls either times. The only bullish samples we have were here. Okay, so this is what I effectively call a spread. A spread is sort of like the spread you're used to, but these bulls filled to themselves, essentially. They filled their own orders. So the market loves to move right back up and sample where the spread started. The cash moved, it's out of the market, and prices like to come back up and resample that initial spot where the spread happened, the initial position, the stop loss, and it came back up to retest where it started. This was just one big fat flex by the bears to shove the bulls out because they can. News? I don't know. Sure, it doesn't matter. What matters is that these bears were effectively able to capitalize and help pushing out the bulls. That's important. These bears said, hey, check out what we can do. And they pushed. And it worked. We could see that those bulls got liquidated. This is going to be a big deal. Okay, so that's quite a big move before the bulls realized what was going on. A little crazy in my opinion. They should have let go earlier. Anyway, bulls did not get sampled here. And they didn't get sampled here. The only way that you would have known to pick this up is what I call bigger fished. And what that is when you have a typical structure in the market and it pushes like this and it goes just fine until you finally see tension curl down right into the low, and you could say, these players are getting liquidated down here and it's a major bullish trend. I'm going to assume that there are much bigger fish here. They're large whales coming in and picking up these institutional traders who themselves are getting liquidated. So I'm looking at this right here as potential bigger fish. There's no trapped orders because this was not retail. This was not retail. This is not these orders coming in from the stock market. Okay, these were orders coming in from institutions getting pressed out, dark pools, the alternative networks, the alternative filling networks or whatever they are, the ADFN, those networks where that you have orders for institutions, people in the background. You're not going to see that show up in trapped orders because that's not who it is. So if bigger fish come in, you can only really pick up on that structurally. And I think we can see right there that those bulls got liquidated. This was their position. This is where that they let go of the open interest, and it was open interest theft on a large scale. We can see that. And we could see that that open interest theft got hit, impacted, the bigger fish consumed the smaller, already large fish. This is a difficult thing to read, but if you keep in context about what's going on, you're looking for teeth. And my philosophy with teeth is always find a good trade and buy its stop loss. That is how you deal with teeth. You just look for the great setup and say, where would these guys get out and get in there? Sadly, it's a good philosophy. I don't know if that's sad. But that's the way it works. So when you have teeth, that's the idea you need. Okay, so now let's look at the bears and what they're up to. So we've been looking at the bulls. They got pushed out. They did not get sampled again, and they're just getting sampled right here. And the question is, do you anticipate these bulls coming in, the ones going on right now? Really quickly, let's take a look at the bears before we talk about the bulls right now. So right here, we have this bearish position. This cross is above, and look, it took a while, but finally finds some samples. So we have bears right here, and it dips under for just a little while and then comes back up. And right here, we have bears again. And you can sort of see that they have this idea, I think, in their head here. But in essence, to liquidate these bears, you're going to need, and I think pretty much all of them, we're going to need a push that's going to be getting up to here. I don't think that anybody's going to think they're wrong until that happens. The initial position that the bears used, that champion, the champion of the down, They that position is right here, and you're going to have to take out their champion before these subsequent positions go. So I think this right here was just doing the spread thing. Okay. And then I think that a move up through that high is going to spike up and liquidate this position. Now we need to ask the question. Okay. So we have bears in the market. They successfully pushed the bulls out. They did not gain control of tension. In fact, they almost did nothing. Now they were here. So this is a legitimate position. Don't take it lightly. That is a legitimate bearish position. The only way that this bearish position is going to get knocked out is if bulls come in with a mind to knock it out. And the bulls have control of probabilities. So you can't look at that bearish position and say, oh, well, that's nothing. It's something. It has to be something. If it's nothing, then there's no reason to liquidate it. There's no reason for it to impact the market. So don't disrespect it. Remember that they're there and that they have enough money to just do this. However they affected it, they did it. So I think that's where we're at. Bears have pushed out the bulls, but basically failed to do anything else. And then the bulls just waited for this. Okay, so there are two things I want to talk about that are a big deal for today that I think are going to help clarify what's going on. The first one, when this market gapped up this morning, right at the open, right here, a lot of people were saying, oh my goodness, the bulls, I'm going to write this because it's important, bulls are getting what they wanted. They were saying this with an ellipses here. So, and the problem here was this was a victory lap. And I say, don't trade your victory laps. The bulls liquidated all of the positions we set up yesterday in the close. They got all of it taken care of. And this was the victory. And it's always dangerous to try and trade the victory. So I think what was happening was a lot of people came in, tried to pick this up on the victory lap, and it wasn't working. So that's important. We had a victory lap trade off the open. People were looking for a gap and go. Not because it was a gap and go, but because the bulls got everything they wanted. And unfortunately, when you have everything you wanted, you don't want anything else. And you need traders motivated to continue to participate in the market. We liquidated all the positions that the bears were holding through this whole dip. So what else could they want? And I think this is a natural result of that, or at least it played into it. The next thing to remember is that these bears were taking advantage of the teeth. They just simply were pushing out what I think could easily be classified as potentially shadow bulls. And the reason I would call these shadow bulls is because they were jumping in to the victory lap. And that's a dangerous position. You hold something. You don't keep getting in. If you have a swing position, then you can hold through the victory lap and potentially add after it blows up in the chasers' faces. So I think you could view these people as shadow bulls. They don't meet the typical definition because they were able to impact tension. And typically shadow traders, they hit, but they can't impact tension, as well as they come in and participate during times when structurally it doesn't make a lot of sense. And I think this was sort of a questionable spot to get in. I don't know that I would terminate a trader who's operating my fund for trading there, but it would be questionable at best, and I might need to have a sit down because that was chasing the victory lap. They should have already been in. Okay, so what's going on right now? The bears took advantage of some weakness. The bulls have shown a little weakness, but almost predictably so. And the bulls are now getting sampled. The question you have to answer is, do you expect bulls to show up? Well, how can you possibly answer this question? Really, there's two ways. You look at the structure. It's really one way, but we're going to break it into two. You look at the structure of the market, and then you look at what they've been doing. And so far, the bulls have just failed. There's no success by the bulls today. But you could also look at the structure and say, well, the bulls failed in a predictable way. They're picking up the teeth. This is what trends always do. So does it make sense for them to, buy in? And you could see that this sample came in, we had volume, and then it pushed lower, and we got a second set of volume here, which this follows the teeth pattern, which is where would you stop out? So we get the sample, it moves, and then starts to run up. Do you expect them to hit? Well, let's look at where the bulls could go from here. They can liquidate this position up here, and this one, and this one. And tension could be moved higher. We could get up to 75, 80 with a push up. We have people on the other side. We have bulls in control of tension. The problem is that bulls have kind of showed a little weakness today, and it's not my favorite. I prefer to hop into things that kind of have this structure where it's like, okay, bulls, you have control. Let's continue. And have seen any success by the bulls. We have just seen none. But if you look at it from a broader perspective, you could say we have a bigger fish scenario, which implies to me that there is a bigger scope going on here than intraday. So will these bulls show up? I think there's a pretty good chance that they will. What about the bears? What could the bears do? Well, the bears are looking at this, and the bears want elasticity. And unfortunately, for the bears, typically elasticity starts off in the morning and runs through the day. And getting elasticity right now is sort of, I don't know, that's silly. Like, the best thing that the bears could get is to see this run out these folks, get all the way up here. Yeah, I'm just going to extend my chart up, or however high we can get it. Get a bullish sample that fails, sample the bears, and then run elasticity all the way back down and as far as they can get it. Like, this is the best scenario for the bears, because that would get tension up just as high as we could get it, and then they could release it back down towards zero and really optimize this move here. And this is the most sensible thing, I think, for the bears to do right now in the context of elasticity. And the bulls could come in and pump this higher by liquidating. And we're getting the scenario that we see often. Both sides want the same thing. And when you get both sides wanting the same thing, you usually get the thing they both want, because they're both doing the same thing. And that is, we got to get this up through this high. We got to get it up through the high. We got to get this tension just as high as we can before looking at elasticity tomorrow. If we can get that to happen, then the bears might actually have a chance. I argue that if the bears push this down now, they completely roll over. I argue that if they shoved it down now, it would be early, it would inject capital in the wrong place, and they would expose themselves majorly to higher levels of risk than they want, because a push down now would just look like teeth to me, and I'd say yum, 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 and buy it right back up along with the rest of the market. And so I think it would be a blatant and obvious ploy to ruin the bears if they pushed it down now. That's my argument, because I think that elasticity should hold off until tomorrow. We could get this much higher, get a much better position for the bears to try to operate from, because remember, the only way for the bears to really get their foot in the door after they've lost control is by permission. Okay? You can come in and brute force it. Sure, that's what happened earlier, and it's not really going all that well. Brute force doesn't work over any longer than a single impulse wave. We know that. The rule of thumb, and it's not propaganda, it's because that's what happens. News bars retrace. It's not because it was news, it's because it was just an impulse. What usually doesn't fit into the structure, and so it will retrace. So what these bears need is permission. They need the bulls to say, okay, you can ride this down, and the bulls say, yay, we now have room to pump it back up because we're getting too high. So this helps the bulls. They like that. They're like, yeah, get it down. That gives us more room. And it helps the bears because, well, one, they get to make money if they can ride that down. We've seen that before, right? We saw this pump really high, and the bulls were able to gap it up. And in this scenario, I think it was sensible, but it ended up being that it didn't work out. It folded over, and the bulls took that elasticity and they did some other things here. We see this all the time. The elastic market is the way to get your foot in the door. This actually was a pretty bad example. As I was going over, I was like, you know, actually, this wasn't a very good example because it was literally a trend reversal and they played it much differently than elastic market. So that was a bad example. I apologize. If you were there, you're looking at me going, that's not what happened. Let's just get a better one. So you can see, okay, so here we pumped it up. They released it here, and same thing, trend reversal things tend to not work that way. You see that? I don't want you to go away from this saying, oh, okay, so if we have high levels of tension and it moves up and price goes that way, it's a trend reversal. I don't want you walking away with that rule of thumb in your mind. It's not a terrible rule of thumb, but if I hear people posting that, I will reply in all caps because it's a rule of thumb that requires a lot of context for it to be true. Anyway, what we're going to be looking at tomorrow is letting, if these bears can get that permission, okay, so back to the permission thing, let's go back there. I just don't feel like scrolling back because we have a little bit of time and I want to get through this before the market does a whole lot of moving into the close. They need permission at some point through like probably the first hour. And permission is given by what I call stepping aside. Stepping aside is where the controlling party gets liquidity and does nothing. They give the nod. They say, go for it. So you see that typically near the first hour. That's typically how this works. And you can see that when, even on these days that were terrible examples, when you pump it really high, it tends to be right off the first hour. You kind of get that idea that it's happening and then it goes. So tomorrow morning, I'll be looking for the bullish sample, no matter how this plays out. And I want to see that bullish sample lead to tension just not doing anything. And then I want to see a bearish sample come in, and then I want to see tension move, and I'll say they just picked up the nod, they're going to try and run this. And you're going to be looking for price to wherever it opens from, say it opens here, you're going to look for price to move down. And what the bears are doing is trying to get a position. So think about the dynamic here. The bulls are going, let this come down, we'll rebuy in. So they're willing to let the bears make money. And the bears are thinking, let's position and try and get as much advantage as possible to keep this going and take out the bulls. It's like, you know, we'll give you a little bit of power because it helps us, and the bears want to use that power to get more. So it's a interesting dynamic that happens all the time, at least 2 or 3 times a month. We see elastic markets, if not more. I mean elastic markets from high levels, like 70, above 60, either side. So that's what we're gonna be looking for. I'd love to see tension move down like this. Okay? So this is important. It's important because if you're just looking at the close for today, then what you're thinking is, okay, well, high levels of tension, so let's gap. This is going to move down. But if you're looking at tomorrow and you're thinking, oh, we have high levels of tension, and you're a bear, you say, well, what's going to get me in the best spot? I think the best spot is to take out these guys. I think that's the best spot. That would be the best spot. If I was a bear, I'd say, let's take those guys out and then run a position down from there because that's better for everyone. I'd be happy. The bulls will be happy because they'll get the market moving up. And we could probably pull it off without pumping tension too much because there's not a lot of bulls in here. I mean, there's a little bit of bulls, but by the time we get there, the market would close. We could literally see it close at like negative 70, maybe 73. Nah, not even that. Probably negative 72% or maybe. If they push this up, that's where we would close. So I think the market has reason to try and get this up so that the bears can have an advantage tomorrow and run elasticity. So let's put this together and think to yourself, I now have something, and we're going to talk about theory here. This is important. I now have an expectation. My expectation is rooted in understanding the motivations of both sides. The bears want a great elastic market. The bulls would like an elastic market as well as further profits today. Both of those look great to the bulls. So the bulls would like to liquidate this position into the close. That's great for them. And my expectations are built on that. My expectations also have to do with what the bulls and bears want in the future, not what they want to happen right now. Then my expectation says, if I'm right, if this is really what is on the mind of the institutional trader, then a move up will say this almost validates the idea that that's what they want. That's what that does. It says, yeah, well, you're getting the things you wanted to make this happen. And we start to see step by step, we get the things that we want. We start to understand what the institutional traders are doing. And then you can start building trading strategies around what's going on. Now, in my opinion, we got this velocity sample here. It played out like a market with teeth, a pretty common thing. And we have everything in place, and I anticipate the market to move up into the close, and that will tell me the market's elastic. If this market drops into the close, and this is going to be a big deal, if the market decides to move down, maybe it's seeing this right here, and a lot of people are looking at that, seeing an expansion bar. Well, really an expansion bar, and the word target is implied, which is that price right there. So if you have prices retracing and then suddenly you have a spot where there's no retrace, it's like, and you're like, whoa, it didn't, you can kind of see right there that we had that right in there. A lot of people are going to look at that and they're going to say, hey, we could drop this down, hit that expansion bar. If this happens, I think that the bulls are just sitting back. I think the bears are getting too aggressive, meaning that they had structural opportunities that could have led to real change in the trend and gave that up for short-term profits. They're too aggressive. They're ignoring the trend. They're giving up the structure, and they're saying, let's just shoot ourselves in the foot, because why not? That's what that would look like to me. A move down right here, like it's looking like it's doing. And I don't know, it could continue, it could not. What I'm saying is moving down here is going to make a statement to me. And that statement is, bears don't want position, bears want quick profits, which is unfortunately the mantra of bears and why they suck. Because all they want is short-term profits that are as big as possible, and they care nothing about the world around them. It's just what happens. Things move quick, they move far, and then they are gone. And so that's unfortunately the issue that a lot of the times the bears have. They can't seem to muster the brain power to try and get control of structure, and it's constantly happening. So will it move down? I think it makes more sense to move up. Honestly, that's what I think, because of the structure we have here, because of the way things played out. The way it looks to me is that a move up it's more sensible for both players. I don't know that this is something that I think is an excellent trade. I think this is an okay trade based on an idea that's still developing in the market. I think we got our victory lap. We built some conflict. This doesn't look super conflicted to me, to be honest. And I like conflict to show up in the market. It looks mildly conflicted to see a position that wasn't really working get pushed out. It's mildly conflicted. But to see these bulls, see some bulls showing up right here, which sort of impacting tension-ish, it leads me to believe that this is still developing. We're still trying to build that conflict that drives markets to places. We're still looking at that. And so my expectation for elasticity is going to help me see how this conflict's building. And then tomorrow, I think we're going to have a much clearer picture of what's going on. Into this close, we have an expectation. We have participants trying to fight, and it seems noodly to me, like they're pulling their punches. That I know this doesn't look like pulling your punches, but in terms of conflict, it doesn't look amazing. I it's not impressive to me. Um, so I think this is still developing. So that said, my official opinion, what I think makes sense for structure, is for these guys to go up as high as they can and open as high as possible tomorrow, not as low as possible tomorrow. Is that going to happen? I think it's sensible, and I've told you what I think it looks like to me if bears shove this down further. Maybe they're just going after this expansion bar. Those are great targets. V price action tends to come back and retrace their expansion bar. It's a common thing. The thing you don't know is the time frame. So if you're going, well, this is going to retrace and hit there, you're like, well, yeah, but what's the time frame? It could have been here. It could be here. It could be the next day. It could wait for another week before it comes back and tests it. Yes, it's a target that people use, but no, it doesn't have a time frame associated with it. So be careful using those targets outside of context. Um, it, yeah. So I still think this makes sense. I don't think this makes sense. I think this would just be like sabotage. Oh crap! I don't know. G-O-U. I forget how to spell sabotage after the G. Oh, okay. How did I identify the liquidity? Okay, the liquidity. So really quick, because somebody's asking how to do that. So you're looking at bearish liquidity. So the bearish liquidity was decay pushed under, and you can see it sat under for a minute. This one didn't quite, but it pushed positive. So we had a cross over the 0 line to the upside, and then we see the trapped orders showing up here. Okay, so we know there's liquidity right here. So the signal, the volume together gives us that. Crossed over 0, and it took a little while to find it, but we finally found some trapped orders, so some buyers willing to buy into the idea. It crossed under 0, and then over 0, you can see there's trapped orders right here. So this is the signal. This is the traders responding to it, creating the open interest to offer to institutional traders. So this is the lowest position that the bears have right now. The worst position they have, but their root position, I'm calling it their champion position, is up here. And so this is the one that I think the market would need to really push through to convince institutions to unwind their position and let go. I don't think they're going to let go until this one gets proved wrong. I don't think that would be sensible. If you're dumping your position right here, it's like, why'd you do that? You basically just covered at the best spot. You should have added or something. I don't know. But so I'm choosing that. And so I have this red line here, and I'm saying I think that's where the institutions would liquidate if the market started to pressure them. Be up through that champion position, and everyone will dump. And there's some traders there. The problem that the bears have had, to keep this in mind, when you track liquidity, you want to see their impact on tension. And this position here had an impact, but it wasn't because they were impacting. It's because they strong-armed price down until these bullish people dumped. So this ticked down because these guys broke, not because these guys came in. So the bears didn't impact tension. The bulls getting liquidated impact tension. There was no... You could see those bulls started to unwind their position. It dipped it down, and that was the bottom. And they've had no follow through really after that. And so the market's sort of been waiting to get more data points since then to see what the bulls are going to do. What are they up to? Are they here? Are they not? Are we going to play? What's the deal? And so the way that I'm looking at that is a bigger fish scenario. So the bullish liquidity, you see that trapped green. We had this move negative. There's the signal. And then there's the traders that consume the concept. Move negative, and then there's the traders that consume the concept. So there's two bullish positions there. Neither of them swept price up. We didn't see a nice hit. Like the bears had this nice hit right there. You see that? They swept it down. The bulls didn't in either position. And then the bulls were impacting tension, but they didn't. We're not seeing that footprint of money coming in. Money. And structurally, they were buying into the victory lap. So not a great spot. And then, well, these guys get liquidated and it creates open interest theft. Whatever longs these bulls had, they handed them over to a bigger fish. So I call it the bigger fish. It's when you have the big fish there's always a bigger fish in the sea. And in this instance, under this structure, for this scenario, what I'm seeing with the way that tension looked and the way the bears came in and hit, this looks like a bigger institution ate a smaller institution. That's what that looks like. And that smaller institution wasn't necessarily wrong. They got strong-armed out of the market. That's it. They got pushed out. So that's different than an institution coming in and saying, hey, structurally, we see great things, blah, blah, blah. They just got shoved out by whoever this was. And we could see that. And so now I think what the market's doing is we get another sample of liquidity here for the bulls, and we get the teeth concept. And teeth is where the good positions get pressed out before they work. So you just sort of, so you can see that the volume came in here and it pushed down a little bit lower, and then it's moving up, and we're seeing some impact here on tension. You can see just it's like, it's not amazing though. And so it looks to me like the bulls are into the close here. Okay, so that makes sense how I got those spots. They have to do with decay, or the energy inside of velocity. That this is measuring the energy inside of here. It flipped positive or it flipped negative. And that concept is triggering traders or algorithms, or they're retailers, uninformed traders, to execute orders, providing that liquidity to institutions to trade against if they would like to. So green means sell orders, not buy orders, so, because you buy against sellers. And red means buy orders, not sell orders, because you sell against buyers. And then during trending markets where there's no liquidity being provided, a lot of times you'll see the green is just, market orders and stuff getting hit, and there's sell orders that continue the market. So it has to do with the structure. Don't just exclusively look at these and say, oh, that looks like I could buy and sell every time. That's silly. It's out of context volume, and it means nothing. You need to say, why did this volume happen? Does it fit in? Is it being used structurally as liquidity, and all those kinds of things? And I think you could do that with any signal. If you can find a signal that's predictable, that is able to predictably generate and trap in traders that can be used in a predictable way as a product. Because if it's not predictable, it's not a very useful product, is it? What are you going to sell somebody? So you say, I can generate a signal that creates this much volume. Would you like to purchase that volume? And I will wait for or generate or whatever that signal, and then you can have that. And you don't have to worry about open interest and all the magic dark pools and stuff. Just, would you want it? And a lot of clients will say yes, or the clients will say, I'd like to fill an order at this price. And then it's the job of the large market operators to make that happen. And the result of that is often generating liquidity at or near those prices. So the objective is predictable. And so when we see this crossover up or down, you could say when energy enters or leaves momentum in the New York Stock Exchange, that predictably triggers traders to act. And so that's why it's reliable liquidity. And I think you can use almost any indication as long as it's reliable and it meets the qualifications that it's broad enough. A lot of people have to see it. It can't be something that's really tiny, like a trend line on an obscure stock. That's not gonna. You need something that's market wide, like the market sees it, whether it wants to or not. If you're looking at a market, you're getting a sense of whatever that signal is. So then you can use it as some sort of liquidity generation signal that you can track over time. And that's important that you track it over time to make sure it's something that, as it develops, it develops the way that it should. I think it's more important to track it physically over time than to back test it over time, because I think back testing eliminates you from the opportunity to experience the market as it happens. And that is the piece that's deleted. Your emotional experience as events happens is completely removed when you back test, which means you back test and you can't understand the most important part, you. The only way you can look back at a historical chart and know what was going on really is if you're so familiar with trading, you go, I would have been mad, or that would have stressed me out, or this would have been a nightmare, so that you can understand the real tension in the market. Because sometimes prices will do things that looking back don't look like anything. But while it was happening, it was like, oh my gosh, this is stupid. You know what I mean? Like maybe price is sitting here doing this thing and everybody wants to see it rise for some reason and it just goes pop. And you're like, oh, and it does this lean pop. And you're like, oh. And then you look back at the chart and it looks like 2 price bars and then a small one and then it moves up. And you're like, this just looks like a great technical signal. And you've missed out on the aspect that is the most important, which is you. You need to become you, the trader, need to become, yeah, that's right, upset, an observer of you, the fool. You, the trader. You must learn to observe you as an indicator. You must learn to see all of the emotions and the feelings and the responses that you have objectively, and you are the best sample. You are the best indicator. This is the best indicator that you have. And if you can't separate yourself in here, if you can't say, I am not my emotions, I am not the way I feel, you will never do anything but burn your money. If you believe somehow that you can be both your emotional self, your foolish self, and a trader, you're going to lose it all. You have to use yourself like an indicator. You have to say, oh, wow, that really got to me. Oh, that's exciting. Ooh, I'm really this or that. And you have to observe yourself as an indicator and allow yourself to feel the market, but don't allow yourself to be that emotional version of you. Sit and watch yourself. Look at how you feel over time. Ask yourself, how did this spike down make you feel? How did this make you feel with the context? What was it that you were looking at in your head that got you to do stuff? Hi. You like those headphones? He needs some milk. So, we have a couple minutes into the close. I'll get you milk in just a second. Can I wrap up with the traders?
First, you have to make me some milk.
First, I have to make him some milk. I'm going to make him some milk. Just a second. All right, I think the boss is happy for a minute. Okay, so this is an important philosophy that you have to master, and it's very difficult. And it typically costs people a lot more than they realize to learn to do that. If you haven't experienced a lot of pain and suffering in your life, you're probably terrible at objectifying your own emotions to see them for what they are. You're probably horrible at that. And it takes a lot of life experience to see yourself, to look at yourself and say, I am not my feelings. My feelings are an indication of the world around me, and to actually objectively use them when it comes to taking risk. It's a hard thing to learn, and it will cost you dearly to get good at. Anyway, so going into the close, have my opinion, up. I would love to see a move up overnight, even if we can get that. If we can get tension to open here would be great, but now that we're into the close and, about flat, tension's going to be looking down. This is a heavy weight on the market. The market really needs to deal with. So keep that in mind. Keep in mind what you're trading with. I think structurally there's some opportunities here. Okay, I do. But I think you really need to keep in mind that at some point the market's going to say, okay, let's take a look at dealing with this. And the way that's going to work, the bulls will say, let's deal with this once they figure out what they want. So if they don't know what they want, they're not gonna just let elasticity happen. So until the bulls figure out what they want, till they see something coming up, they're not gonna do it. Okay, so there's a reason that we started here. Once they know what they want, they start to deal with it, right? And as they deal with it, we can start to figure out what they want, what it is you're looking at, where you're going with this. And right now, I don't know what the bulls want other than just keep on trucking until we see that elasticity come in, until we see how it's structured. I think it's sort of just, this is bullish. It's just bullish. And the bears are just going to have to deal with it. And we've seen this was actually a pretty good example the other day when the bears decided to get aggressive. I mean, we had pretty high levels of tension and then they just ran with it. It wasn't necessary to reverse the market. It's just, structurally it was available. And they ran with it and we got all the way down to like 95%. So is that what the bulls want? Do they want to just kick it? Because if you just shove another day and get to 95%, you're saying to me, short term, if you gap this up and continue higher, I'm gonna be like, what are you doing? Burn off that tension before you run another leg, you sillies. This is coming back on you, just like the bears did the other day. That's what happened to them. They pumped it and got this to 95% and it didn't go well. Same thing. What do these bulls want? So we don't really see that until we see how elasticity deals and what they do with the high levels of tension. Then we'll start to see what they really want over the next couple days. And we'll start to get some much clearer objectives. So again, up, here's the target. Overnight, it's going to be basically a push through today's highs. And then tomorrow, think about elasticity. Elasticity is the act of the controlling party stepping out of the way so the counterparty can ride the tension down and give that controlling party better prices. All right, I will see you guys tomorrow. Good luck trading. Be safe.